A financial storm is brewing over the Greater Toronto area. It's not a question of if, but when. A tidal wave of mortgage renewals is set to crash into homeowners, triggered by the end of the cheapest money we've ever seen. We are talking about a massive renewal cycle peaking in 2026, with well over 1 million mortgages renewing nationally in that window, and a heavy concentration right here in the GTA. This isn't just another market cycle. For thousands of families, this is a direct threat to the equity they have built, and in some cases, to the very homes they live in. This video is not about fear-mongering, it's about facts. The era of 1.5% interest rates is a distant memory, and the payment shock that's coming is very real. I'm going to break down the full scale of this renewal crisis using the latest data from the Bank of Canada and CMHC. More importantly, I am going to give you concrete, proactive moves you must make right now to protect your family and your finances. So what exactly is this renewal wall? It's not a physical wall, but it might as well be for the families who are about to hit it. The term describes a massive concentrated wave of mortgages, all coming up for renewal around the same time. The peak of this wave is set for 2025 and 2026. Why then? Because it marks the 5-year anniversary of the home buying frenzy of 2020 and 2021. During the pandemic, the Bank of Canada dropped interest rates to historic lows to stimulate the economy. Millions of Canadians, especially in high-priced markets like the GTA, jumped at the chance. They locked in 5-year fixed-rate mortgages at rates below 2%, some as low as 1.5%. At the time, it felt like a golden opportunity, but that 5-year clock is about to run out. According to the Bank of Canada, approximately 60% of all outstanding mortgages are set to renew by the end of 2026. This is a staggering volume of debt repricing in a very short window. And unlike those who renewed it in the past few years, this group is moving from the lowest rate in history to a much higher, harsher reality. Even with rates expected to fall from their recent peaks, they will be nowhere near the world of 2021. Let's make this real. Imagine a family who bought a townhouse in Mississauga in early 2021. They paid $950,000 with a 20% down payment, leaving them with a mortgage of $760,000. Their 5-year fixed rate was 1.89%. Their monthly payment would have been around $2,900. Now, let's fast forward to their 2026 renewal. Even if a good fixed rate is closer to 4.5%, that same mortgage with the balance now paid down to around $680,000 would see its monthly payment explode to over $3,800. That's a $900 a month increase. For many others, it will be over $1,000 a month. That's over $10,000 a year after tax that a family needs to find just to stay in their home. This isn't a worst-case scenario. For many, it's the base case. And this is all happening against a backdrop of stubbornly high inflation. This is the renewal wall. Now, why is this situation a potential catastrophe? Specifically for homeowners in the GTA. It comes down to a combination of 3 factors: higher debt loads, shrinking equity buffers, and rising delinquencies. First, the sheer size of the mortgages. The example I just used of a $760,000 mortgage is common across Peel, York, and Durham region. In Toronto proper, it's often much higher. A bigger mortgage means a bigger dollar-for-dollar impact for any rate increase. A 2% rate hike on a $400,000 mortgage is painful. On an $800,000 mortgage, it's devastating. Second, the market has turned. The explosive price growth that gave homeowners a massive equity cushion has stalled, and in some areas, even reversed. Recent data shows GTA home sales dropped 11.2% in 2025 compared to the previous year. Prices for detached homes in some areas have seen notable decline, and the condo market has also been hit hard. That equity people were counting on to refinance their way out of trouble is shrinking. This puts families who bought at the peak with a small down payment at serious risk of being underwater, where they owe more than their home is now worth. This leads to the third and the most alarming point: payment shock and rising financial distress. The Bank of Canada's own analysis is clear. For those with 5-year fixed rate mortgages renewing in 2026, the average payment increase is expected to be between 15 and 20%. But averages hide the real danger. The bank's data also reveals that for about 10% of borrowers renewing in 2026, the payment increases will be more than 40%. Think about that. A $3,000 mortgage payment becomes a $4,200 payment overnight. We are already seeing the cracks appear. While national mortgage delinquencies are low by historical standards, they are trending up in Ontario. In Toronto, the mortgage delinquency rate saw a 60% year-over-year surge as of mid-2025, reaching a level not seen in over a decade. This is what happens when financial pressure begins to build. People miss a credit card payment, then a car loan, and finally the mortgage payment is the last thing to go. The warning lights are flashing, and the renewal wall will only intensify this pressure. If these numbers are making you anxious, that's completely normal reaction. But anxiety isn't a plan. The good news is you have time and you have options. Before I break down the specific strategies you need to be implementing today to build your own financial defense, do me a quick favor. If you're getting value from this analysis, please hit that like button and subscribe to the channel so you don't miss critical updates. It helps us reach and help more homeowners just like you. Okay, let's turn this fear into a plan. The single biggest mistake you can make right now is to do nothing. Waiting for that renewal letter from your bank is like waiting for a storm to hit before you fix your roof. Your bank will send you a renewal offer, and it's often at a rate that is convenient for them, not competitive for you. You must be proactive, and here are 7 steps you need to take. First, don't wait for your lender. You should be planning your renewal strategy 9 to 12 months before your maturity date. This gives you time to shop around, gather all the documents, and negotiate from a position of strength. The best deals are rarely given to those who will wait until the last minute. Second, the amortization extension. This has become a key survival tool. If you have a $700,000 mortgage renewing and your amortization has been paid down to 20 years, your payment will be high. But if you are eligible, you might be able to stretch that amortization back out to 25 or even 30 years. This will lower your monthly payment significantly. The trade-off is that you will pay more interest over the life of the loan. But in crisis, managing monthly cash flow is king. This can provide the breathing room your family needs. Third, a strategic refinance. If you still have equity in your home, now is the time to consider using it wisely. I'm not talking about renovating the kitchen. I'm talking about a refinance to consolidate high-interest debts. If you have credit card balances at 20% and a car loan at 8%, rolling that debt into a new mortgage at a lower rate can drastically reduce your total monthly debt payments, freeing up hundreds of dollars to absorb the higher mortgage cost. Fourth, negotiate everything, fixed versus variable. The choice between a fixed and variable rate is more complex than ever. A fixed rate offers stability and peace of mind. You know exactly what your payment will be for the entire term. A variable rate may offer a lower starting rate, but it comes with the risk of future increases. There is no single right answer. It really depends entirely on your personal risk tolerance and financial situation. Fifth, understand the stress test hurdle. Here is a critical point. Recent rule changes mean that if you simply switch lenders at renewal without changing your loan amount or amortization, you can avoid the stress test. However, if you need to refinance to take out more equity or extend your amortization with a new lender, you will likely have to pass the mortgage stress test all over again, proving you can afford payments at your qualifying rate plus 2%. This is a major hurdle and exactly why starting early is so important. If you can't pass, you have time to work on a different strategy with your current lender. Sixth, build your post-renewal budget now. This is non-negotiable. Sit down and calculate what your new mortgage payments is likely to be. Then build a household budget around that new higher number. Where can you cut back? Dining out, subscriptions, daily coffees. You need to find those savings now and start putting the extra cash aside. This will soften the blow and build an emergency fund. Seventh, and most importantly, get a professional audit. You wouldn't perform surgery on yourself, so don't try to navigate the most complex mortgage market in a generation alone. Talk to an independent mortgage professional. They have access to dozens of lenders, including credit unions and monolines you can't access on your own. They can run the numbers for your specific situation, model the impact of different strategies, and find solutions you didn't even know existed. The 2026 renewal wall is not a myth. It is a mathematical certainty. For thousands of GTA homeowners who bought during the boom, a significant financial shock is coming. But I want to be very clear. This situation is serious, but it is not hopeless. Panic is not a strategy. A proactive, informed plan is your only defense. By understanding the numbers, exploring your options with amortization and refinancing, and engaging a professional well in advance, you can navigate this challenge. You can protect your equity you have worked so hard to build. This isn't about simply surviving the next few years. It's about taking control of your financial future in an uncertain world. The power is in your hands, but the time to act is now. If you're a homeowner in the GTA and your mortgage is renewing in the next 6 to 12 months, please don't wait. I have opened up my calendar for personalized, no obligation renewal strategy calls. We look at your specific numbers and help you build that long-term plan. The link is in the description below. Book a call today. Don't wait until it's too late.